Welcome back to the deep dive. Today we're really getting into the weeds with Vijaya Diagnostic Centre Ltd VDC, one of the big diagnostic players down in southern and eastern India. We've got a pile of filings here from November 4th, 2025. It covers their Q2 and H1 results for FY26, some strategic expansion plans, and this is the big one, a major corporate restructuring.
Yeah, and our mission today isn't just reading out numbers. It's about tackling what looks like, well, maybe a conflict in these filings. VDC is growing revenue pretty fast, but you see the margins softening a bit.
Right. So is that a warning sign? Or is it actually part of the plan, like an intended consequence of them being
Huh.
so ambitious with their strategy?
Exactly. And we think the answer comes from first understanding the legal stuff, the restructuring that actually cleaned up the numbers so we can analyze them properly.
And then testing these claims they're making, particularly about breaking into new markets like Bengaluru so quickly, it sounds almost too good to be true.
It does. So to really get the operational health, you first have to understand the, let's call it, the structural engineering they just pulled off. They basically used the court system, the NCLT, to tidy up their corporate structure, which means restated financials.
Okay, so our goal is to translate that legal stuff, which looks pretty dense, let's be honest, into something clear. What does it actually mean for an investor, for their growth?
That's the plan.
Okay, let's unpack this. And yeah, we really have to start with the legal side. It's the foundation for all the numbers we're looking at.
Right. So we're dealing with an NCLT-sanctioned scheme of amalgamation. NCLT, that's the National Company Law Tribunal. Think of it as India's dedicated corporate court. And this court approved the full merger of Medinova Diagnostic Services Ltd, that's the transfer company, into VDC, the transferee company.
Okay, simple enough, merger approved. But you mentioned the dates are critical here. Why?
Because they tell different parts of the story. The NCLT order, like the official stamp of approval, that was October 13th, 2025. Then you have the effective date. That's when they filed the order with the Registrar of Companies, making it all legally binding. That was November 4, 2025.
Okay, October approval, November effective date. Got it.
But, and this is the kicker for the financials, the appointed date for the whole scheme was way back on April 1st, 2024.
April 1st, 2024. So the legal bit finished in November 25, but the accounting effectively starts over a year and a half earlier. What does that actually mean when I look at their results?
It means they had to use something called the pooling of interest method. Essentially, it forces them to treat Medinova as if it was always part of VDC right from the start of the previous financial year, April 1st, 2024.
Okay. So it creates a clean comparison, like comparing apples to apples, even though the merger just happened legally.
Precisely. It tidies everything up, makes the balance sheet consistent, gives us clean figures for Q2 and H1 that we can actually compare year on year.
And this cleanup, it had immediate effects on November 4th, right? When it became effective.
Absolutely immediate. Medinova Diagnostic Services Ltd, as an entity, just poof. It stands dissolved without winding up.
Dissolved without winding up.
Mm-hmm.
Sounds like legal jargon for disappeared cleanly.
That's exactly what it is. It avoids the whole messy, expensive, time-consuming official shutdown process. Just consolidates everything instantly. And as part of that, Medinova's directors, their KMPs, that's key managerial personnel, the top brass, and their statutory auditors, all vacated from office on November 4th. They're now under the VDC umbrella.
Okay, makes sense. Now, VDC already owned a big chunk of Medinova, didn't they? Over 60%.
Yeah, they held a 62.14% stake. So, step one, that existing investment is just canceled, extinguished, wiped off the books.
And the other shareholders, the ones who held the remaining, 38%?
Right, the non-controlling shareholders, they get new shares in VDC. There's a set share exchange ratio. For every 22 shares they held in Medinova, they get 1 share in VDC.
Okay, a straightforward swap.
Pretty much. And they set a record date for figuring out who gets those shares. That's Tuesday, November 25, 2025. So it ensures everyone gets integrated cleanly.
Does this merger bring anything else into the VDC fold? Like geographically?
It did, actually. A small piece, but potentially strategic. Medinova Millennium MRI Services LLP, which was a subsidiary of Medinova, automatically became a wholly owned subsidiary of VDC on November 4th. This LLP operates in Kolkata, West Bengal. Now, it's not huge. Its turnover last year was around 2.36 crores, about 23.6 million rupees.
Small, but it's a foothold in Kolkata, right?
Yeah.
Which you mentioned is an expansion target.
Exactly. It immediately gives them a bit more presence on the ground there. We'll definitely come back to Kolkata later.
Okay, so the structure is sorted, the legal stuff is done, the books are restated from April 2024. It's clean. So here's where it gets really interesting. Now we can actually look at the operational health. Based on these clean, restated numbers for Q2 and H1 of FY26, how's the engine running? Is it strong?
The engine's definitely powerful. If you look at the half-year ending September 30th, 2025, their revenue from operations hit nearly 3.9 billion rupees. That's 3,896.1 million. And that's up a very healthy 14.9% compared to the same period last year. Q2 was solid too. Revenue grew 10.2% year on year.
Okay, 15% top-line growth for the half year. That sounds pretty good. But what about profit? Is that growth translating to the bottom line, or are they, having to spend a lot to get it?
Well, that's the core question, isn't it? The profit after tax, or PAT, for H1 FY26 did grow, but a bit slower than revenue. It was up 11.2% year over year, reaching about 819 million rupees. And this is where you really need to focus. The margins are shrinking. H1 EBITDA margin landed at 39.9%. That's down 58 basis points from last year.
Almost a full percentage point drop in EBITDA margin.
Well, 58 basis points, so just over 0.5%, but Q2 was even sharper. The profit after tax margin for Q2 dropped 155 basis points. That's over 1.5 percentage points down, landing at 21.5%.
Okay, so margins are definitely feeling some pressure. Usually that might mean tougher competition forcing prices down, or maybe some internal inefficiencies creeping in.
Yeah.
What's your read from the sources? Are they losing pricing power?
That's the critical thing to figure out. And honestly, the sources strongly suggest, no, it's not about losing pricing power. It looks much more like a deliberate strategic choice to invest heavily.
How can we tell?
Look at the expense lines. Employee benefits expense for the first half, up 15.7% year on year. They're clearly hiring people, likely for the expansion. But the real telltale sign is capital deployment. Depreciation and amortization D&A, that line item, it was up a massive 28.9% year on year for the half year, almost 29%.
Wow, nearly 30% jump in DNA. That's huge. That means they're spending serious money on what? Equipment, new centers, things that depreciate over time.
Exactly. That's the footprint of aggressive spending on high-end long-term assets, the kind of expensive equipment that goes into these new diagnostic hubs they're building. They seem to be intentionally sacrificing some short-term margin points to equip these new centers with top-tier tech. Think 3T MRIs, advanced CT scanners. That huge jump in DNA is basically proof on paper that the expansion strategy isn't just talk. They're writing the checks, and it's hitting the P&L now through higher fixed costs.
Okay, so if the margin pressure is from investment, not price cuts, then the revenue growth must be coming from more people using their services, right? Not just charging existing customers more.
Absolutely correct. The data overwhelmingly shows it's volume-driven growth. That signals strong patient trust, and they're gaining market share. Total tests performed in H1 FY26, 8.22 million. That's up 12.2% from the previous year. Huge volume increase.
And the price per test?
That only went up slightly. Average realization per test was 474 rupees. That's up just 2.4% year on year. So much slower than the volume growth.
So they're deepening their reach by serving more patients, getting more tests done, not by jacking up prices. That makes sense.
It does. And it fits perfectly with their customer focus, too.
Right. They're still heavily focused on B2C, aren't they? Individual patients walking in, paying out of pocket rather than big insurance contracts or government deals.
Incredibly focused. That B2C share is still sky high at 92%. It's basically a retail healthcare play. The service mix is pretty stable, too. Pathology is about 62% of revenue. Radiology is 38%. That hasn't shifted much.
Any other interesting shifts in what people are using them for?
Yeah, one positive trend is their wellness share percentage. That's the revenue from preventative health checkup packages. It actually increased from 13.6% in H1 last year to 14.3% this H1.
Okay, not a massive jump, but it's moving in the right direction. Suggests people are buying into proactive health, which is probably good for repeat business.
Exactly. It's a good sign for future customer loyalty and recurring revenue streams.
All right, let's connect this back to the strategy, the reason for that huge DNA jump we talked about. Where are they actually putting all this money? It seems like a dual strategy, right? Defend the core, attack new markets.
That's a perfect way to put it. Defending the home turf means ensuring their core markets. Hyderabad still dominates with 68% of Q2 revenue, and the rest of Andhra Pradesh and Telangana, ROAPT, adds another 19% remain fortresses. But they're not just sitting still there. They're actively upgrading the technology within those core markets.
Can you give us some concrete examples? What kind of upgrades?
Sure. In October 2025, just last month, according to these filings, they opened 2 major new hubs. One in Nandyal, Andhra Pradesh, and another in Khammam, Telangana. The Nandyal hub, interestingly, features the region's first 3T MRI. That's a big deal technologically, a real differentiator against local
Ein
competitors.
Commam.
Even more advanced, actually. The Kamam Hub has both a 3T MRI and a high-end 160-slice cardiac CT scanner, so they're making sure even their established areas have the latest and greatest tech.
So protecting the core with cutting-edge stuff. And they also added a spoke center.
Yeah, a smaller spoke center in Alwal, Hyderabad, in September. That's about increasing density, making access even easier within their most saturated market. Defend and deepen.
Okay, that's the defense. But the really exciting part, maybe the justification for the margin dip, is the offense, the new markets. Let's talk Bengaluru. This feels like the big test case. Can their model work outside AB Telangana in a super competitive city like Bangalore?
This, for me, is probably the single most impressive takeaway in the entire filing. The commentary from the MD and CEO specifically calls out their Yelahanka hub in Bengaluru. Get this. It achieved break-even, profitability within just 2 quarters of starting operations.
2 quarters, wow. What was their original forecast for break-even there?
Their own internal projection, the plan, was for it to take a full year. They did it in half the time.
Okay, breaking even in 6 months instead of 12 in a brand new competitive city. Now, it's incredibly fast. What does that speed tell you about how effective the VDC model is compared to whoever was already operating in Yelahanka?
It tells us a couple of really important things. First, their B2C-focused hub-and-spoke model seems highly tuned for entering new markets efficiently. It just works. And second, it suggests there's huge underlying demand in these big metro areas for the kind of service VDC offers: high-quality integrated diagnostics, likely with good tech and a strong brand.
So the playbook translates, and it works fast.
Yeah.
That makes that big DNA increase look less like a cost and more like a very smart investment.
Absolutely. It immediately validates the spending. If you can get profitable that quickly, the upfront investment pays off rapidly.
And are they doubling down in Bengaluru now that they've seen this success?
They are. Big time. Building directly on that Yelahanka success, they've now finalized the lease for what sounds like a massive flagship center in another part of Bengaluru Bannerghatta. This won't be just another hub. They're talking a fully automated lab, really advanced radiology, including PT-CT capabilities. They're moving from just proving the concept works to aiming for a dominant position in a key area of the city.
Okay, Bengaluru looks like a major win. Now let's swing over to West Bengal. You mentioned they picked up that small MRI LLP there through the merger. How are they building on that foothold in Kolkata?
Right, Kolkata is the other big strategic push, and they're moving fast there, too. In Q2 FY26, they inaugurated their 3rd new hub center in West Bengal just this year. This one's in Kasba, Kolkata. It's a decent-sized facility, over 5,250 square feet. And following the pattern, they're highlighting that it houses the region's first 3T MRI. Same strategy. Enter with high-end tech.
So replicating the tech differentiation they used in AP and Telangana, bringing the fight to the incumbents.
Exactly. They're trying to build that same kind of dense, high-tech network they perfected back home, but now in Kolkata.
And are they stopping at 3 hubs in West Bengal for now?
Doesn't sound like it. They explicitly state that 2 more hubs in West Bengal are already on track to be commissioned in Q3 FY26, so before the end of December 2025.
Wow, so the pace is really quick there too.
It is. The amalgamation gave them that initial operational entity, the MRI LLP. But it's the aggressive capital spending, the new hubs, that's turning that small foothold into what looks like a serious strategic presence very quickly.
Okay, so let's try and tie this all together. What does this all mean? We've dug through a complex legal merger, seen decent top-line growth driven purely by volume, and identified that the margin squeeze seems directly linked to this massive investment in expansion, especially new hubs with advanced tech.
I think it means VDC is running a playbook they have very high confidence in, even though it requires significant capital upfront. Structurally, the merger gives them that clean operational base, consistent financials going back to April 24, which is great for transparency. Operationally, you've got the stability from the core markets churning out volume, while the big investments in expansion are already showing remarkable results, particularly that rapid break-even in Bengaluru.
And for you, the listener, it reinforces this picture of VDC as a company focused on scale. They're up to 159 centers now across 27 cities, and they're sticking firmly to that B2C integrated diagnostic center model.
Absolutely. So the final thought, maybe the provocative question for you to mull over is this.
Given how well Yelahanka did, breaking even so fast and with the big banner Gata Center plan, how aggressively can VDC keep replicating this success? Can they repeat that Bengaluru performance in Kolkata and potentially other big metro markets? And crucially, is the margin pressure we saw in H1 purely down to this expansion plex and the associated capital costs? Because if they can replicate Bengaluru's speed elsewhere, then that short-term margin pain looks like a pretty smart price to pay for potentially dominating these valuable markets in the long run.